something I've been thinking about. If you are not a speculative investor, if you're a long-term investor, and yet there are these speculative investors buffeting your returns about, what should your reaction be? Should you be doing anything differently?
I think basically you should not be doing anything differently. I mean, investment is a pretty simple thing. Investment is owning businesses, or I would say, being an inveterate index fund person, owning all of American business, owning every company in America, letting capitalism do its work. Those companies will grow at probably around 7% a year. They'll pay you about a 2.5%, somewhat lower than history, but a 2.5% dividend yield. And that should, over time, bail you out of anything that happens because of the wild swings. I mean, if you visualize investment as growing in kind of a steady line, which it does, and visualize the crazy market as being all these jags up and down around this steady line, upward, always upward, I think, then you've got to say, I know I'm not smart enough to get out at the high. I know I'm not smart enough to get back in at the low. So I'm just going to stay the course, as we would say at Vanguard, and hang on through all that. And importantly, if I'm trying to accumulate money for retirement, or to buy a home, or to educate my children, what you want to do is keep investing. And say, how can I keep investing the day that the market goes down 600 points? That's the greatest time in the world to invest. It's certainly better than doing it the day before it goes down 600 points. And I think people have lost sight of the fact that a sharp market decline is, of course it's bad for sellers, but it's good for buyers. And since the stock market is the interaction of sellers and buyers, it's always good for somebody.
Right.